Aaron, thanks again for joining us today. Remind our viewers, KeyStone Financial and what you do there.
So what KeyStone is KeyStone is an independent equity research firm. And what we do for our clients are individual investors, and we make individual stock recommendations to those clients. So one of the things that makes us different from a lot of other companies that do that is that we are completely independent. And what that means is that we only work for our clients. So we're not trying to do investment banking or financing deals with the companies that we research. It's a subscription-based model, so the investors that use our research are the ones who pay us, and that way there's no conflict of interest, so we're completely out for their interests. What we're focused on with our research is finding profitable, growing companies that can be purchased for our clients at reasonable valuations relative to what's going on in the market. So companies that have interesting things that are going on, interesting business models, or are servicing interesting parts of the economy where we see real opportunity for that company to potentially double, triple their earnings over, say, a 3 to 5 year period. We're very price sensitive, and we think that that's particularly important in this type of a market where the valuations are high, because we've had, in the US anyways, we've had 8 straight years of very strong returns. So it's not about necessarily finding the cheapest stocks, it's about finding good quality growing companies that can be purchased at a reasonable price. That's what we've been doing for almost 20 years now, and it's been a great success, and we're just staying disciplined to that strategy and continuing with that.
Well, Aaron, you mentioned the US market and some of the research that you have directed towards towards our neighbors down to the south. Give us some of your insights into perhaps what's happening there now, what opportunities you're seeing, and whether or not the investor sentiment is still high considering the political economy down there.
The investor sentiment in the US is extremely high right now, we find. I think that there's a recognition that the market down there has had 8 straight years pretty much of excellent growth, and the valuations are extremely high. And a lot of people are wondering, when does this end? When does that cycle turn around? And is there a crash on the horizon? So that's something we always try and pay close attention to. We're not trying to predict when such a crash is going to occur, when such a market reversal is going to occur. We just make sure that we build a good quality portfolio for our clients that is going to basically survive through such a situation. But one thing that we love about the US market is that it's so broad, and there's such diversity of opportunities down there compared to Canada.
Yeah.
About 50-60% of the companies up here in Canada are attributable to two sectors. So that would be financial, and that would be resources. Yes. So that's a lot of high industry concentration in the Canadian market. And when you look at technology in the Canadian market, the technology sector, it's actually the second to lowest. It's single digits. It's about 8% of the Canadian market. We live in a world where there's all this technology innovation going on. Everybody's excited about it. So it's a little bit sad sometimes to see that such a small part of the Canadian market. But when you look down on the US, technology actually makes up 18% of their market down there. So there's just so many more opportunities in the US, so many different types of companies and industries and things, innovative business models that you can access. So that's what we're doing, and that's why we brought our research down to the US. It was 2.5 years ago that we expanded our research to the US market, and since then we've outperformed the S&P 500 in both years by a significant margin, and we attribute that to just the strategy that we use, which is once again to focus on profitable growing companies and not overpaying for those companies. We're just being very selective, and we're not buying into a lot of the hype that is occurring in certain industries. We're looking for companies that have some staying power, companies that where their growth is not completely dependent just on some cyclical phenomenon like higher oil prices or higher metal prices, or not completely dependent on GDP, where in many ways they have more control over their own destiny.
Yeah. And sorry, how much of your portfolio is weighted towards US stocks now?
Well, we actually separate our service into 3 categories. So we have small cap Canadian companies, we have Canadian dividend growth companies, and then we have the US market separately. So in terms of what an investor should put into US stocks relative to Canadian, that is really such an investor specific thing. It depends a lot on individual risk tolerance, on time horizon. But I would say that most Canadians, just because of the high industry concentration that we have here in Canada, most Canadians should have a significant amount, a meaningful amount of their portfolio invested in US stocks. So that might be anywhere from 20 to 30% or beyond that even.
And you have a US tech stock that you like right now. Tell us more about that.
Yeah, so the company is EBIX. The symbol is also EBIX, EBIX. It trades on the NASDAQ. We actually recommended this company about 2 years ago, a little over 2 years ago. It has tripled since that time, but the share price has tripled, but we still love the stock right now. They're a technology company, they're a software provider. They do the digital backends for big insurance companies and other financial firms. They're heavily into payment services, that kind of thing. But when we originally recommended them, this was a company that had a multi-year, more than a decade track record of continuously growing their revenues and their earnings per share. And this was even through the financial crisis of 2008. They continue to grow. This is an example of a company where they're not so dependent on just what happens with GDP or just what happens with the overall economy. Yeah. They're able to go out and source their own opportunities by creating innovative technologies and then bringing those technologies to potential clients and providing some type of a value to those clients, like saving them money or streamlining their processes. Yeah. So right now the company is trading at about $80 per share right now.
Okay.
But it's a growing company. They did several acquisitions last year. About halfway through the year, they acquired a company in India called It's Cash, and they're going heavily into the payment processing sector in India, which they believe is a huge opportunity for them. So this is a growth stock. They've continued to grow over the past 10 years consistently. They have an excellent outlook going forward over the next year. What they're expecting is for revenues to continue to grow and for margins to improve over the next year. Valuation-wise, when we recommended them, they were trading at about 17 times earnings, which relative to the US market back then was cheap. Now they're trading at about 26, 27 times earnings. Okay. So it is more expensive, but when you compare that to other companies in the US, the valuation is actually quite reasonable. And then when you look forward, when you consider the growth over the next 1, 2, maybe 3 years, we think that valuation has become much more reasonable. So it's a recurring revenue business model, which we really like, and it's a company where you just see a very visible path to growth. We think this company can double their earnings in the next 2, 3, 4 years, and that could potentially lead to another double in the share price as well.
Well, there you go. Thanks so much, Aaron.
Thank you for having me.